Hello, Rockstar Inner Circle members. This is Tom Karadza, and this is a monthly Rockstar Inner Circle audio. And this month, we have a Rockstar member who has a ton of knowledge in a very specific area. Well, Carlos, I think you have a ton of knowledge in many areas, I should be clear, but you have a ton of knowledge in this specific area as well. We have Carlos Rodrigues on the phone with us. He is a VIP member. And for those of you who don't know Carlos, let me just give you a little bit of background about him. Carlos is an award-nominated 11-year veteran of the financial planning industry and president of Magellan Wealth Management Incorporated. It's an independent financial planning brokerage based in Hamilton, Ontario. He's been featured several times in different Hamilton newspapers with articles such as How to Make Your Mortgage Interest Tax Deductible, which is obviously an interesting topic to everyone. Carlos became a member of the Rockstar Inner Circle in 2008, and shortly after that, he became a VIP member. He's married to Sharon Rodrigues, and they have a 14-month-old daughter named Allegra. Am I pronouncing her name properly?
That's exactly it, yep.
Okay, great. And I'm sure she's 14-month-old, so you guys are busy then.
Very little sleep last night, let's put it that way.
Yeah, I can imagine. I hear you. Okay, so we wanted to bring Carlos on the phone with us on this particular call because a few months ago, I don't know if it was 6 months ago or 7 months ago, we shared in the Rockstar Inner Circle newsletter, the monthly newsletter that goes out to all members, some of our thoughts on insurance. And it's kind of one of those topics that nobody seems to like to talk about very much. It's always put on the back burner, I find. But it is a really important topic, and it deserves some serious attention, even if it's for only brief moments in everyone's life. There's brief times we think you really need to buckle down and focus on insurance. For myself, my own journey, I could care less about any type of insurance when I was single. I was just telling Carlos earlier before we jumped on this call here that when I was single, I had already had some properties, and I didn't really care about any insurance. I just cared about, as Carlos, we were saying, cared about how much money I had to go out on the weekend. So it was really a low priority. But as soon as I got married and began to have children, insurance got really important to me. And that's when I kind of started reading up on it and figuring out how I wanted to tackle all this stuff and what amounts I wanted to get and so forth. And then it took a different spin when Nick and I started our own business. Then I wanted also different types of insurance, and I added on to the insurance. So I went from somebody not caring about insurance at all to now I think we carry a lot of insurance, and I joke about it sometimes saying, oh my God, we're so overinsured, but it really is just a joke. I really value all the insurance that we carry right now, and it kind of just makes me sleep easy, and I think everybody needs to at least be aware of this information. So that's what we're going to do with Carlos right now. And Carlos, I wanted to start with something really maybe that's basic to you, but to me and to I think a whole bunch of people out there, when they begin looking at insurance, one of the topics they look at is life insurance, and it gets somewhat confusing. Can you start at the very beginning, perhaps, and explain to us the difference between the different types of life insurance? And what I mean by that is there's, from my understanding, there's the term life insurance, there's universal life insurance, and I'm less familiar, but I know it's out there. There's whole life insurance. Can you kind of just maybe break them down for us a little bit so that people understand maybe the different types of life insurance?
Absolutely. And really, there's really only two types of life insurance, and that's term insurance and whole life. Whole life is sometimes referred to as permanent insurance, okay? Term insurance is the most basic type. Now, I'm going to speak in general terms because, quite frankly, there's companies out there that brag that they have 1,800 different products and variations on them. So I'll just keep things nice and general, and so you get an overview of what's out there. Term insurance, like I said, the most basic form of life insurance. It's you pay a certain premium and you get a certain amount of life insurance coverage. There's no real bells and whistles to it. Some people may be familiar with like cash values and things of that nature. Normally with term insurance, you don't have that, okay? Where the confusion happens with a lot of people is that you have, that term of term insurance, 5-year term, 10-year term, 20-year term. A lot of people think that once you get to the end of that term, that the policy is over and done with, and this is not the case at all. Generally speaking, term insurance runs until age 85, but this is assuming that you allow it to get to that point. And why I say that is that at the end of every term, okay, so if you have, for example, a 10-year term life insurance policy, it'll go 10 years at a certain premium, and then at the end of the 10-year period, it'll renew, but when it renews, the premium jumps, okay, and it'll typically jump 3 to 4 times what you were paying in the previous term, and then it'll stay at that price for the next 10 years, okay, in this particular example. So this type of insurance is normally used for temporary needs, insuring a mortgage, for example, making up an income while, there's 2 spouses and the kids are at home. Something happens to one of the spouses, you may want to make up that person's income to the family so, lifestyle continues on the way that you had it. Then you have whole life insurance.
Okay, so before you get into whole life, can I just jump in there for 1 second?
Sure.
So my term life insurance, I think that I have multiple term life insurance policies now, which, just kind of the way things happened. But the first term life insurance policy I got, I'm pretty sure, and this is kind of maybe even just embarrassing to admit, I thought my term was like 25 years. Would that have made sense?
Yeah, I mean, there's several different multiples out there. I mean, you can have even a term to age 100, okay, where it stays at one premium until you're age 100. But
and the reason... Go ahead. Okay, the reason I got the term life insurance, my thinking, and I know we're going to get into this after you explain, but my thinking just originally looked like, okay, you know what, I want $1 million worth of insurance. Should something happen to me, I want the mortgage on our current property to be paid off, and I want the mortgages on some of our investment properties to be paid off. And, so if something happens to me, then my family has that kind of thing. That was my thinking, Carlos. Rightly or wrongly, that's kind of what I was thinking. I was like, pay off this house mortgage.
You were in the right direction. Basically, you're not going to always have a mortgage, right? So there's no need to really have a permanent type of life insurance policy where you'll keep it until, you're well into your 80s, 90s, or beyond that, right? So to go into a whole life type of policy where there's a lot of bells and whistles, there's really no need.
Yeah, okay. So that's what I guess I was getting to. This to me was like a very simple type of insurance, almost like you're buying car insurance. This was like all right, I'll get insurance for this amount. It pays off these things. Should something happen to me, my family will be comfortable at that point, and we're good. And after that, I went and got more term life insurance after that initial policy. But that's kind of my thinking. It was just very simple, covers the things I want to cover, and that's it. So, and it sounds like that's the intended purpose of that type of insurance. Very basic stuff. It's for a dollar amount over a certain period. You pay the premium, and if something happens, that's the amount that's cashed out.
Exactly. But, I mean, just the fact that you have it, it gives you options down the road that if, God forbid, you ever get sick and you can't qualify for more insurance if you need it, you can always convert that to a different type of life insurance that now has cash values and all this other good stuff.
Okay, cool. So I didn't even know that. Okay, so do you want to? I don't know if you're going to share more about that stuff, or do you want to go into whole life now?
Well, I mean that's pretty much it with term insurance. Normally, anyways. Normally, I mean there's always variations, like I said, right? But the typical type of term insurance it's called term renewable and convertible. Okay, the renewable part speaks to the each term cycle that you have. So if you've got a 5-year term, it'll renew every 5 years, 10-year every 10 years. The convertible part is any point in time while you have that policy, you can convert it into a more permanent type of life insurance, which is whole life. Okay, or even some companies will allow you to switch it to a term to age 100 policy, where you lock in the premium, and it just keeps going until you're age 100. Now, if you do manage to make it to your 100th birthday, somebody will show up with a check for the death benefit. And I almost had to do that this year. But
wow, really?
Yeah.
Oh, geez.
Now,
okay, so give us a little bit more detail then on the whole life.
Well, on whole life insurance, like I said, it's synonymous with permanent insurance, okay? Basically, there's no real renewal period in that type of policy. Once you start paying a certain premium, normally that's the premium that you'll pay for the life of the policy. Tends to be a little bit more pricier than term insurance, because now you have an investment component that comes along with it. Whether you choose to control that investment component or, have a type of policy called a participating whole life policy where, the company takes care of the investment portion of it and pays you out a dividend into the policy, is your choice. And that's where, universal life is a form of whole life insurance, but it's the easiest way to explain universal is it's term to age 100 with an investment account tacked onto it, okay, where you can pick the mutual fund or a GIC or a savings account to attach to the life insurance policy. And that's pretty much it. Outside of that, there are multiple variations. You can mix and match the different types of life insurance to fit your particular need. And, when you start getting into the whole life insurance and universal life insurance, there's a lot of tax planning that you can end up doing with that stuff, especially for the business owner. Okay, you can enhance retirement concepts. You can shelter money in there. If God forbid, I know that there's not many rock stars that probably do this, but if you're adding to your RRSPs and you max out your RRSPs, and you're still looking for a spot to put money away so that it's not getting hammered with taxes, you can shelter it in a life insurance policy. Because any money that grows in a whole life insurance policy or a universal life insurance policy grows tax deferred.
Okay, so on this note, because I want to talk more about this stuff, just to give kind of everyone some other thoughts on this stuff, is when I went down this insurance path, I was kind of just of the thinking, rightly or wrongly, and maybe naively when I was first doing this, I thought, you know what, I'll just take the cheaper term life insurance because I think I'm smart enough with my investing that I don't want to pay any premium, any extra amount, whatever you call it, a little bit more expensive for a whole life type insurance policy that has the investment kind of part tacked onto it, because I'll just save the difference. So I'll pay the cheaper amount and get the term life insurance. I'll pay a little bit less money, and any money that that I would have put into getting a whole life policy, I'll just take that money and I'll invest it and I'll manage it completely independently. I'll do it myself, and that was my rationale. However, looking back, I think I like my decision, but that was just my thinking. I thought, why am I going to pass my money over to somebody else to manage it? Because I think I can figure this out myself pretty decently. But that was kind of my thinking. But on the whole life insurance policy, something that comes up, or different insurance people have always kind of tried to convince me about it, was like, oh, well, Tom, it's kind of like a forced savings thing, and if you need some money, 10, 20 years after you start the policy, and that whole life insurance has accumulated something in the investment side of it, or in the entire policy, I don't know how it works, you can borrow against it. You can borrow money and, give yourself that money. Is there some kind of, do they have these different kind of features? Do whole life insurance have these features?
Oh, absolutely. I mean, like if we look at, for example, what's called a participating whole life insurance policy, you're basically in business with the life insurance company, and your compensation for being in business with them is they pay you out a dividend every year on the anniversary of your policy. It goes back into the policy. Now, whether you take it as cash or just let it grow in the policy, but there's other features and whatnot that I won't get into for simplicity's sake. All that money grows in there tax deferred, and yes, if you wanted to access that cash, it's your cash, you can through, whether it be a policy loan or some other type of strategy. I think, for most rock stars, I'm sure you'll agree with me that, we can do a lot better outside with a piece of real estate as far as growing an investment, but from a tax planning perspective, it does give a lot of ability as far as, for example, if somebody has a corporation, when a business owner has all this money that they don't want to pull out of their corporation and get taxed in their name at 46.41% or whatever the rate may be, they leave it in the corporation. But if you're not using that money in the day-to-day actions of the business, eventually it could attract a lot higher a tax rate. So what do you do with that money? Well, if you've got a holding company, you can have corporately owned life insurance, which is basically just a life insurance policy owned by the corporation, the holding company, in their name. It's still on the particular business owner's life, but owned by his corporation rather than himself. You can move money from the operating company to the holding company through a tax-free dividend, and use that money to buy or to pay for the premiums. But now, just that fact that any money that you put into your life insurance policy beyond the death benefit, that cash value portion of it, all of that is held tax sheltered. So now the problem that you had of, well, this money might, if it's just going to sit there, it's going to be taxed a lot heavier. If you put it into the life insurance policy, you don't have that problem anymore. Okay,
and so it's interesting that you say that, because I think our accountant has been on us for the last 2 years to kind of dive into this with our holding company, and we've been putting the money in our holding company in different investments and kind of just basically, I think, ignored them. but I think this upcoming year we're going to be talking about this a little bit more seriously, and we've never really quizzed them. We've just always been like, yeah, don't worry, we'll get to that point where we have purpose for our money, even in our holding company. But I think this upcoming year is finally we're going to kind of break down and let them kind of go through all this stuff with us. And I didn't realize what it was about. So now I'm a little bit more clear. It's when you have money that is accumulating and you're not putting to good use in some way, instead of holding just cash in the holding company's bank account, you can use corporately owned life insurance as a mechanism to, it sounds like, is it deferring taxes or reducing that tax rate?
Yeah, and it's when you it doesn't have to be corporately owned. You can do this as a regular individual if you just wanted to shelter money in there. But to really maximize the features or the abilities of life insurance, if you have a business and it's incorporated and you have a holding company, this becomes really, really valuable to shelter money there. But I mean, the fact that you put it into the policy, now you still got to get it out if you want to use it down the road. And there's strategies that you can use to bypass any kind of tax. I shouldn't say even bypass. And you may end up paying a little bit of tax depending on the strategy. But take, for example, I know many of us have, on the mortgage applications, they'll ask, do you have life insurance? Well, they're not asking for the death benefit. They're asking for the cash value of any particular policy that you might have.
Okay, and explain the difference again, just so everyone's clear, between the death benefit and the cash value.
Yeah, the death benefit is if you died, this is what's going to be paid out tax-free to your beneficiaries, or whether it be a corporation or your family, whoever's listed on the policy as a beneficiary, that's who that money is going to go to tax-free. Then there's a second component, which is that the cash value component that builds in the life insurance policy. This is separate from the life insurance death benefit, And I do find
but you would only have that if you had a whole life insurance policy, correct?
Right. Okay. With the universal life insurance policy, it's if you've put more money beyond the premium.
Got it. Okay. Yep.
Normally, I'm using pictures and graphs and whatnot to help people understand this. So hopefully, I'm making a clear picture here for people.
You're doing a good job. It's all good. Yeah.
Awesome. Now, that money that sits in the life insurance policy, how it gets taxed, if you pull it out, it's first dollar in, first dollar out. So your principal would come out first, and then if there's any growth on that, then that's would come out last, and you'd be taxed on that, and it's 100% taxable.
Got it.
As far as that growth that's there. But because your bank will see your life insurance policy with a cash value as an asset, now you can use it as collateral. Okay, so you can go to the bank and say, hey, I got this policy with all this cash value in it. I'd like a line of credit. And when you borrow money from your line of credit, nobody's getting taxed. So now, if you've got this life insurance policy sitting in your holding company with oodles of money and cash value, and you want to access this as cheaply as possible, go and get yourself a line of credit. If you're going to go and buy some more real estate, fantastic. Now you got a line of credit to go and buy more real estate.
Huh. I didn't know people were doing that. And then you use the life insurance as a collateral for the credit, the line of credit, and banks do that. It sounds like regularly.
Oh yeah, Scotiabank, for example, will I believe it's 90% loan to value. There are others depending. Now this depends on the type of life insurance policy that you have. If it's a whole life participating or if it's UL, they'll both be treated differently. Universal life, typically it's 70 or 75% loan to value. Okay.
So I'm curious, what kind of guidance would you give someone listening to this that says, oh, geez, you know what, I have some life insurance with I work in a corporate job, and they got that whatever they give you, it's like $25,000, I think, or whatever that amount is on these jobs, $50,000. I don't know if it's higher these days. But what would you give someone who says, you know what advice would you give to someone who says, I really need to get some insurance? Do you have a preference between term and whole life? And I know this is a big question, Carlos, because everybody's situation is different. But just at a high level, somebody who, they're married, they have a child, maybe 2 kids, and they're not sure if they need more insurance. Do you tell them would you kind of say, without knowing details of everybody's case, would you go down the term life policy first, or would you explore whole? Do you have a preference for either one? And then after that, so do you have a preference? After that, I have another question on this topic for you.
Well, it's not really. I try not to go down the road of terms better than whole life or vice versa, because it's kind of like hanging a picture, right? You can choose between a regular hammer or a sledgehammer. Okay, depends on it's not the tool that matters. It's the job that you want to do. Okay, so to say that term is better than whole life or whole life is better than term, really it does it an injustice, simply for the fact that the job that you want to accomplish, what do you want to see happen if something happens to you, is the real question to answer. And you use either a mix or one or the other to answer that particular question. Okay, like take for example, if you just wanted to pay for your burial, well, term insurance, the likelihood of you having your term insurance around by the time you get to the point where you're going to die, it's unlikely to be there, simply because the cost associated with term insurance over time, after you get 1 or 2 renewals, if you even let it go that far, is going to be quite substantial, and you would have saved a little bit of money with a whole life policy.
And is there any guideline? Yeah, I can see how much that you really need to. So for everybody listening to this, and if it's not obvious already, you need to sit down and kind of come up with a game plan, and that's why someone like Carlos is useful, because you really need to kind of, just the way we all kind of strategize and how we're going to get all our mortgages. You know how we all spend a lot of time on figuring out how we're going to get the next property? Right?
Yeah, exactly.
You need to spend just as much time, obviously, planning this stuff. Are there any rules of thumb that is used in the industry for how much insurance somebody needs? Or again, is that what is the goal, and then let's look at the insurance? Is there, like, in the industry, is there just like a general rule of thumb? I know in some industries, in different niches, there's like all these rules of thumb, like, if it's a family with 2 children, it's this much insurance, this many times their income, or if it's a single person, it's this much. Are any rules of thumb, or is it all unique based on what you're trying to achieve?
You know what, that question, the answer is basically how many different types of advisors are out there, right? Everybody has their own philosophy to that. But for myself, I take the approach of what's the problem, what do we want to see happen if that particular person passes away, and if they do, how much are those problems going to cost? So once we figure out what those problems are going to cost, what they want to see happen, then now we have an accurate way of saying, okay, this is how much insurance I need. Okay, rather than saying, well, I think $250,000 will do it, which honestly, you could be leaving huge gaps. And
it's funny to hear you say that, because that's really how I started with it. I was like, you know what? I think this $1 million policy on term, that's going to be just about right.
You know what I mean? You might as well throw darts at a dartboard and say, that's a good number.
Totally. Yeah. We've gotten a little bit more strategic since then, but I don't know exactly how much on the insurance. But so it's good to hear you say that.
Yeah, I mean, we're like all rock stars are more than likely, like you guys preach, is you're building a legacy, right? So now we want to protect that legacy. We want to protect our loved ones. I'm assuming most of the rock stars out there are like that, and don't want to just wash their hands. Hey, I'm dead. What do I care?
Yeah, I hope so too, but you never know. Maybe someone upsets someone, and that's how they are. But I think you're right. Most of us are here to leave a legacy. You're right.
Beyond the scope of this phone call for sure. But anyway, so that's basically it. Figure out the problem. How much is that problem going to cost? And then now you've got a number to work with, and you can go out and get the appropriate types of life insurance for your needs.
Okay, and you know what? One last question, because we, just in the interest of time, I have a whole bunch of other things I want to ask you. But on the term life and the whole life insurance, I remember getting the term life insurance, and when I re-upped and got another policy, a nurse came to visit and took my blood pressure and weighed me and all that kind of stuff, and then I qualified for their different level. I think actually Nick was all upset because at that time he was working out and really Mr. Fitness guy. I was doing nothing, but I qualified for like a higher level or a cheaper policy than him based on my stuff.
Preferred rate?
The preferred rate, the super preferred or whatever it was.
Yeah.
He got preferred, I got super. Is that done one time, like over that, if you had a term life policy for 25 years, I don't think a nurse has come back. So is that's just done once up front and
once up front,
never again? Yeah, okay.
Exactly.
Is it the same thing for whole life insurance?
Exactly. So, I mean, now it depends on, one, the person's age, to the amount of insurance being applied for, okay, because, I mean, certain companies will go, for example, up to $500,000 and no medical testing needed, okay, but others will bring that down. You may have to get I know, for example, my own life insurance policy, when I first took it out, when I got married, I had a blood pressure test done, a blood test, urine sample. The nurse came right to our house to do that, but they took height, weight, and all those measurements, and then they took that back, and it came out all clear. So I had some great rates with that. As far as getting the preferreds and the super preferreds, each company again is a little bit different. But take for example Nick. He's got too much muscle on him probably, and that's why they give him the preferred rate.
I'm going to tell him that your muscles are causing you a problem. It's not benefiting you. It's costing you money. See, that's his language then. That's speaking his language.
So, each company, they do have their charts, for example, as far as, where certain testing gets done. How old you have to be, how much life insurance you're applying for will affect the types of testing, if any testing at all, needs to be done. And when you do apply, it's one time, and that's it.
Okay. Okay, so, I want to move on to just a little bit different topic in the insurance world here. Is after we locked up, life insurance policies for ourselves and stuff, shortly thereafter, it became important to us when we started kind of working on our own to get other insurance. And the one we went for, and again, it was, a little bit of throwing darts just at the wall. We went for disability insurance. And I remember being in shock at how much, because I remember thinking, okay, this is how much money I bring in every month. So should something happen to me, I just want that much money coming in. But I remember when I was applying for this policy, it was like some weird calculation of the average income over the last 3 years, and it wasn't quite as much as I wanted, but it was rather pricey, I thought. I still got it because I thought it was valuable. But is disability insurance, can you explain how that works? Can you just say, if something happens to me, I want, $5,000, $10,000 a month to come in, or not? Because it doesn't. I don't remember it being that way. How does that structured?
Yeah, well, I mean, disability is it's a little bit more difficult to get as far as an underwriting perspective. Okay, so life insurance is the easiest form of insurance to get. Disability is a step up. They're a little bit more stringent in what they're looking for as far as health, and they're not going to give you a bigger income while you're disabled than what you were making when you were healthy. Okay, so anybody out there that is like, oh, okay, well, I can afford a lot more than what they're giving me. Give me as much as I can.
Exactly. Yeah, exactly. Which I thought what you could do. Yeah, you can't do that, right? Yeah. Okay.
No. An insurance company's goal is to get you, ideally anyways, to the same level of after-tax income that you had before the disability during the disability. Okay. So typically what you'll end up seeing is that they'll cap it at 75% of your pre-disability income. Okay. So if somebody is applying for disability insurance, get ready to pull out your tax statements. If you're a business owner, your ledgers and things of that nature, like your income statements and balance sheet is typically what they'll ask for, a couple of years at least. For the general person, the last 2 years worth of T1 generals is the average of what's asked for to prove your income. And, they'll also ask you questions on, do you have disability insurance elsewhere? Because it's not just that one policy that they're looking at. They're looking at an all-source, it's called an all-source maximum. Okay? So, I mean, yes, there are strategies that you can do a little bit of double dipping, but at the end of the day, there is a cap on the kind of benefit that you can expect from a disability insurance policy. 2, not all disability insurance policies are equal, hands down. You definitely have to be aware of the 2 types of disabilities when you're looking at a disability insurance policy, and the definitions of disability that are used in the contract. Okay, so the 2 types of disabilities when an insurance company is looking at this is it an accident or is it an illness? And how do they classify the 2? Okay, typically, if you can trace your disability or the cause of your disability to a specific time and date, it's an accident. Otherwise, it's an illness. Okay, the curious part here is that, or the interesting part here is that most disabilities are sicknesses or illnesses. And it's pushing like 80% of all claims tend to be illnesses. And this is like, for example, a bricklayer that carries 50-pound bags of concrete up, hundreds of flights of steps. Eventually, his back breaks down. He can't go to work anymore. Well, that's not an accident. That's an illness. So he goes and makes his claim or whatever. Or if he had a disability insurance policy, this is where you tend to see the premiums really skyrocket, is that if it covers illnesses, expect a higher premium than a disability insurance policy that just covers accidents.
Okay, and so that brings us kind of just naturally to the next point, is that after disability, we also learned that there was critical illness insurance, which is what you're alluding to, I believe. And is that, so that's even, because right now I don't think Nick or I have that particular type of insurance, but that one even has a higher premium, if I'm hearing you correctly?
Well, it's even more difficult than the disability, like the top rung as far as difficulty level of acquiring when you're doing the underwriting. It's the most stringent underwriting is done for critical illness, but when you've got stats like, 1 in 3 people will get cancer by the time between the ages of 18 and 65 or something like that. So it's not a question of if you're going to get it, it's when almost. Okay.
Oh my gosh.
So with stuff like that, that's you tend to have a much higher types of premiums and really rigorous kind of underwriting. But the difference here is that critical illness, though, if you, God forbid, are diagnosed with a cancer or something along those lines, stroke, heart attack. Those are the three major illnesses that are normally covered in any kind of critical illness policy. With the critical illness, it pays out if you're diagnosed with one of those critical illnesses. It'll pay out a lump sum once. Okay. Now, this is generally speaking. I mean, you can have riders that will allow you to have a second occurrence of critical illness, but generally speaking, if, for example, you were diagnosed with cancer, life-threatening cancer, okay, it can't just be I got a little spot on my arm and the doctor went and froze it, so give me my $100,000 now. That'd be nice, but anyways, no, this is a life-threatening critical illness. If you survive it, it pays out a lump sum of money to be used tax-free.
Got it. Unlike disability, where disability is isn't that a monthly ongoing kind of income type insurance where you're getting something every month? Yeah, okay.
Exactly.
Critical illness, lump payment out based on the illness. Got it. Okay.
Okay. It's a relatively new type of insurance in North America. It was developed by a doctor from South Africa, and it became it's very popular over there and spread to Europe and then came over to North America. So, I can understand that there is a little bit of confusion. Is critical illness disability? Is disability critical illness? Do they do the same thing? No. The payouts are different. And, depending on the cause of each will dictate whether or not, critical illness is used or disability or even both. If you fall off a ladder, you're not going to get critical illness. You're going to get your disability payment.
Got it. Okay. And so those are the main types of insurance for individuals typically, the life insurance, disability insurance, and critical illness. Is there another one? Or are those the main ones?
Those are the main three that, if anything, people should look at. If you're, obviously we all have limited budgets. Nobody can just go out there and drop $3,000-4,000 on average anyways to build a perfect insurance plan. So, I mean, if you are going to go out and you're looking to mitigate these risks, I'd say, if anything, if you had to pick two, start with life insurance or disability. Pick either one because, I mean, if you don't have an income coming in, everything falls apart. You need that cash flow. And disability will mitigate that particular risk. From there, you've got your life insurance or it's your choice which one you go with first and your budget. But those two there are where I would say, people should go to first. Critical illness.
I remember. Go ahead.
If you're going to go with critical illness, it tends to be more a question of, do I have the budget for it? And if you do, absolutely, go and get it because, like I said, the stats that I see are downright scary. But anyways, now I sound like a life insurance salesman.
No, you're doing great, Carlos. You're doing great, actually. I remember when we got disability, the person I was dealing with said something to me, and I don't know if this is used in life insurance sales, but it kind of made sense. It said, look, if your income is primarily driven by your efforts, think of yourself as like a cash machine, and you're the cash machine. You're the one who produces cash, and should something happen to you, wouldn't you want to insure that? And think of it like you had a cash machine in your basement that produced cash for you, and you needed that to live. Wouldn't you buy insurance on that machine to make sure nothing went wrong with it? And I remember thinking, you know what, geez, I don't really, it's just like any talk with insurance. I don't think anyone gets too excited like they're jumping up and down like, oh my God, let's talk about insurance, But when they put it that way,
I don't know about you, but
but when they put it that way, I thought, you know what, yeah, at that point in time, and still, I mean, we're very active with stuff we do. But at that point in time, it was probably even more important. And I thought, I really should get myself insured because, yeah, I am the cash machine for my family, and I should insure myself. And that's what kind of drove me to get the disability insurance. But okay, Carlos, I want to move on to something else that's really important because I don't know if a lot of people know this, and it's around insurance on mortgages. Can you share with everyone your thoughts, your knowledge, your experience on, somebody gets a mortgage, whether for their own primary place of residence or for their investment properties. And when you go to the bank, they ask you rather quickly, say, oh, do you want to get insurance on this mortgage? Should anything happen to you, then the mortgage is, will be paid off. And it's relatively inexpensive from what I recall whenever I've been explaining to it. And often it's just a quick little initial here and there when you're closing a mortgage, and you get this mortgage insurance from the banks. And since then, we've kind of learned a whole bunch of things, and now I don't know if we'd even advise people to go down that path, but you'll probably have better talking points to this. Can you kind of explain, the difference maybe between getting insurance from the bank on a mortgage or using a different type of insurance to insure some of the things you have going on with your mortgages?
Absolutely. And that mortgage insurance that is made available by the lending institution, honestly, in my opinion, it's a huge waste of money, simply for the fact that it's a very poor quality type of coverage. I mean, if you can't get coverage anywhere else, it's better than nothing. But I'm almost of the school of thought that, hey, you know what? I probably would benefit more from nothing. A lot of people just tell me, it's almost useless in their eyes. But can you explain why? Like, why do you have that opinion? What is it about that type of insurance? The way it's paid out, or why is that? Yeah, absolutely. It's first off, who gets paid if something happens to the life insured? Okay, because it is in a life insurance that you're buying for the mortgage. Okay, with mortgage insurance through the lending institution, the beneficiary is the lending institution. So think of it this way: you're paying them premium to cover your life, just in case, so that the mortgage gets paid out, but they're the beneficiary. Okay, and it only covers the amount of outstanding debt. So if there's other problems that arise, and quite frankly, 99% of the time when somebody passes away, there's other financial issues that come up that you're going to need ready cash available to go and deal with them. So, if it just covers the amount of the outstanding debt, it really straps you down a little bit. But think of it this way: that premium that you're paying to the lending institution for the mortgage insurance, it doesn't go down. Okay, so every month that you're paying your mortgage down, you're making headway to paying your mortgage down, but your mortgage insurance gets more expensive every time you pay your mortgage down, because your premium's not going down with it. So your premium in relation to the outstanding debt, the premium stays the same, the debt's going down, so technically your mortgage, your insurance is getting more expensive in relation to the size of the debt. If you had a mortgage of $250,000 and you're paying, let's say, $40 a month for it, fantastic. But if you died 10 years down the road, you're still paying the $40 a month up until that point, but only the amount of outstanding debt will be paid off. But you're still paying $40 a month. I know that if I was paying $40 a month for something, I'd want what I initially bought it for, right? If, for example, you wanted to refinance your mortgage somewhere else, you'd have to requalify for that coverage. So if your health isn't so great at the time, you may not end up being able to move your mortgage. If you don't qualify for mortgage insurance, this is rare, but I've seen that a bank, will say, well, because you can't qualify for the mortgage insurance, we're not going to give you the mortgage. I don't know how prevalent that is, or even if it was actual fact, but, I've heard that before. The coverage isn't even guaranteed, because they see if you're actually insurable at the time of the claim. It's called post-claim underwriting. So you're dead. Now we're going to go and see if we can insure you, but you're dead. How much sense does that make? And what about the actual paying out? I think there was this CBC documentary that was kind of thrown around a few years ago. I think they were trying to explain that, when you get like a term life policy, the nurse comes and checks you out and sees if you qualify for the policy, and then it's done. You've qualified. But on mortgage insurance from the bank, is there a possibility that it's not paid out because something wasn't declared properly right up front when you got the insurance? Is that just a scare tactic from insurance companies, or is that really
something that people should concern themselves? And am I explaining it clearly? You know, if something happens and you have the insurance on the mortgage from the lending institution, you really just sign some papers declaring some stuff. And I don't know how many people read all the fine print on these things. So that if something happens and it's time to get the insurance policy paid out from the lending institution, if there was some sort of health issue not clearly described or explained or admitted on these forms, the insurance might then not actually be paid out. Am I explaining this clearly?
Yeah. Well, I mean, like I said, with mortgage insurance, they don't do a rigorous underwriting process up front to see if you're insurable. Okay. Basically, the last time that I saw a mortgage insurance application, there's 3 questions on it. And if you pass those 3 questions, you basically have the right to pay them the premium. Whether you're covered or not is only going to be determined after a claim is made. Okay, whereas with a term insurance policy, which is the best way, in my opinion, to cover these types of debts, they see if you're insurable right up front. If a contract is put in place, if somebody hands you a life insurance policy and you're paying that premium, then, as long as you haven't committed fraudulent misrepresentation on that contract or lied on that contract with the intention to deceive the life insurance company, or committed suicide within the first 2 years of the policy, your beneficiaries are getting paid, period. Okay.
But on the lending institution one, is it feasible that you quickly answer those 3 questions and you're being honest? You don't mean to mislead them, but you don't fully even understand all the details they're asking, so you initial it off thinking that you're being very upfront and honest on your answers. But at the time that the insurance needs to be paid out, the bank discovers that you went to see a doctor for something, and because of that, that wasn't admitted at the time that you got the insurance. The policy's not paid out when it needs to be paid out. Could something like that happen, or am I just confusing
Absolutely.
the situation?
No, and that's not a scare tactic. It's actual fact. Okay, that when you're dealing with health issues or the question of whether a person is healthy or not, it's never that simple. So to be able to answer that question effectively in three questions to an applicant, that's going to be very, very difficult, and honestly, it's impossible. So, I mean, when you compare, for example, a mortgage insurance app, and a term insurance, life insurance application,
the very different.
Is expensive. Okay, I mean,
pages and pages difference. Yeah.
Yeah, I mean, if you're buying a life insurance policy, expect to answer a couple of pages worth of health questions. Now, it's yes or no questions typically, and if there's I've got high blood pressure, for example, well, they'll ask you for a little bit of an explanation, but you're giving them the ability to make the assessment: is he or she insurable? If, like I said, if your agent or even ourselves, if you do end up calling us to explore this a little bit more, if we put in place, if we hand you a life insurance a life insurance policy, and you're paying for that premium on time all the time, you're covered. Period.
And I think just if I'm buying insurance, I want to know I'm covered. So when we learned this information, we were just advising everybody, and we stopped getting any sort of insurance from new mortgages that we picked up. And we just always would bump up if we wanted that particular mortgage insured, we would just go and get more term life insurance instead of getting the insurance from the lending institution. That was our approach, rightly or wrongly. That's what we did. So that's part of the reason.
And that's a perfect approach to it. Just keep in mind that you can have as many different life insurance policies as you want from as many different life insurance companies. The only thing that eventually, it's not how many you have, it's how much you're covered for, that eventually they may say, okay, well, how much life insurance total do they have? The life insurance company doesn't want you being worth more dead than alive.
Yeah, for obvious reasons, you don't want to be an attractive target.
Yeah, so typically it's a multiple of your income. So the average is 20 times your income or something along those lines. But eventually, if you're making, for example, $30,000 a year, don't expect to be insured for $12 million.
Yeah, good point. And I've always thought of insurance. So thanks for explaining the bank, the difference between the lending and station one. I think that's really, really valuable and important for everybody to understand. It's a big point. And just on the life insurance.
Here's another point, though. Even if all that stuff doesn't make sense to anybody, a term insurance policy, especially now, is cheaper normally than a mortgage insurance coverage.
Why are you saying especially now?
Well, because with interest rates being as low as they are, a lot of insurance companies are raising their premiums to mitigate that particular loss in their portfolios.
Got it. Okay. And what about with term life insurance? Here's something I've always thought, and I'd be interested to, just hear your thinking on this. I always thought I'm going to get this term life insurance and for a set number of years, 25 years when I first started getting it. And I thought, after that, I don't really care. I'm not even going to renew any of those term life insurance policies after 25 years because I'm going to have all these real estate properties and the debt on them is going to be gone or very, very little. So I'm going to have a lot of equity in my life. So I might keep a little bit of term insurance to cover some things, but in general, I'm not going to need as much insurance because my just overall net worth is going to be in a very different situation at the end of that period than it is today. And that was my thinking. And that was part of the reason I thought, I'm not going to go with the whole life. This is the approach I'm taking. How crazy does that sound to you?
Well, there could be a little problem. Well, not a little problem. It's, depending on the size of your estate, it could be a big problem because in Ontario or in Canada, we have this little thing called probate, and it's basically a death tax. So if your estate is worth millions and millions of dollars, if you wanted that money to go to your heirs, well, the government's going to step in and say, okay, well, Tom's dead now. We're going to take a little bit bigger a chunk than just the income tax that he owed us on all these properties. Because after you die, a couple days after you die, everything is deemed disposed or sold. They put a price tag on you, and basically from that number is where they calculate how much of a death tax you'll pay. So it's great that you have term insurance now, and from a tax planning perspective, hopefully you die within that 25 years. Sorry, Tom.
No, that's all good.
I like it, but at the end of the day, it's all about money, right? No, but with a whole life policy, it goes beyond those 25 years or the intended period that you had planned to have that life insurance, and it ends up being actually cheaper. Most of the times anyways, to pay the insurance premium as opposed to paying the death tax out of your estate.
Got it. Makes sense. And that brings up a whole other of questions on wealth protection and just tax management and kind of brings up a whole accounting side of things as well. So yeah, there's so much in this. That's why, although we can kind of joke that life insurance isn't the most exciting thing. When you get really into it, like you're describing now, Carlos, like it is interesting because you need to have these discussions and these thoughts because you don't want to work your whole life and then have the inability to pay the probate tax or be structured incorrectly so that it really hurts you more than it should and these kinds of things. So that's why I think it's often easy to neglect this stuff, especially when you're first building your real estate portfolio or your businesses or your wealth. But you don't want to ignore this stuff for very long at all because it plays a role at all different stages in your life. At the beginning, the term life insurance might be more important for one reason. At the end, like you're saying, might be important for another reason. So at different stages in all our lives, these things are important topics, and I don't think they should be ignored. But if you talk to me about this, I'm 40 right now. If you talk to me about this 15 years ago, I'd be like, oh, yeah, whatever, But it played no part in my thinking. But you don't want to leave it too long. This stuff is an important thing. And I know I'm preaching to the choir here with you. You obviously agree with this stuff.
Yeah, absolutely. Well, it's like you guys said. We're here to build a legacy, to improve our family's lives. And but at the end of the day, it's not just what we make; it's what we end up keeping.
Yeah, well said. Well. Okay, so unfortunately, we're coming to the end of our time together because there's a lot more stuff we can talk about, and this might warrant further follow-up at some point down the road with some other things. But I'm glad we had this discussion because we covered a lot of important points. I think it was really valuable for everyone, Carlos, so thank you for that. Can you tell us what you're up to now? Because I think a lot of different members are up to different things, right? Building their portfolio, starting different businesses, and you're up to some pretty cool stuff. Can you explain to everyone what you're in the middle of launching something either right now or very soon? Can you describe it?
Yeah, well, it stems to, dealing with that problem of mortgage insurance. Like I said, my company's Magellan Wealth Management, but recently we've launched a website that people can go on. It's called ZippyQuote.ca, and if you just want to, shop different rates and whatnot on term insurance, you can go to this website, and it's really simple. You put in your basic information, male, female, age, stuff like that, and you can actually get quotes from all of the major companies in Canada for term insurance. And basically this arose from, Dave Butler and I, we've become pretty good friends, and we sat down for lunch a couple months ago. And, I asked him, how come you guys keep selling this mortgage insurance or making it available? And his answer was basically, we don't have anything better to offer. Having a life insurance rep in the office just, most of the time isn't feasible. And to get this done and put away, you end up with offering mortgage life insurance. So with that statement, we came up with ZippyQuote. And basically somebody can go on, they can shop all the life insurance companies in Canada, and if they see one that they like, they can click on it and submit an application right online. They never have to meet with a life insurance agent. They can certainly call us and we can help them over the phone. But if you don't want to meet with us or you don't have the ability, if you live up in Thunder Bay or whatever it may be and, there's nobody up there to come and see you, we can certainly take the application over the phone and, within a couple of days you end up with a term life insurance policy as opposed to the mortgage insurance that people normally have.
That's really cool, and everyone should check out the site. It's really a clean, easy site to run, and then like under 30 seconds you get all these comparison quotes. It's really cool. It's nicely done. So that's ZippyQuote.ca, ZippyQuote.ca, ZippyQuote.ca. And Carlos, one more thing. If someone wanted to reach out to you just because they had questions on this topic, they wanted to get insurance, they just wanted a second opinion on the insurance they have, knowing that you're a Rockstar Inner Circle member and we all kind of think the same way, they might be interested in kind of reaching out to you. What's the best way? Do you have an office number or an email address that they can use to reach out to you?
Yeah, either way is fine. We have a toll-free number, 1-888-586-2199, or you can email me directly at Carlos, Carlos, at ZippyQuote.ca. So ZippyQuote.ca.
Okay, and so the number again is 1-888-586-2199, and it's Carlos at ZippyQuote. Sorry? Oh, it's Carlos Rodrigues.
I thought you were giving my full name. No, it's
Carlos at you are Carlos Rodrigues, though. We got that part down. But the email is Carlos at ZippyQuote.ca, correct?
Yes.
Very good. Okay, Carlos, I really wanted to thank you for all this information. I'm pumped about ZippyQuote.ca. That's kind of really cool. I know you're just launching this, and it's fun to watch you go through this whole experience. At one point, we're going to have to share how you first found us and your thinking about coming out to see us and why you came to see us. But we'll save that for another day because that's a good conversation.
Yeah.
We'll save that story, but that's going to be a good story that we're going to have to share with everybody at some point. But it is very cool. I mean, we feel really honored to be working with people like yourself and with all the knowledge that you have, and to have you part of the Rockstar Inner Circle membership. I mean, it's just a really good feeling. So thank you for taking the time. We know how busy you are to share all this information with everybody. I'm sure everyone really found it valuable. That's it for this month, everyone. Thank you very much, Carlos. I'm sure we'll be talking to you again soon.
Thanks for having me. It's been great.